Okay, we're live. Good morning, everybody. I'm here with Daniel. He's a local lender. We're going to have him introduce himself, and today we're going to be talking about the top 5 questions you should ask about a reverse mortgage. So we're going to get into that in a second, but before we do, just wanted to remind everybody to like and subscribe on the channel. You can follow Dan or myself on all the social media platforms, but when you get a moment, if you like what you see here, please put some comments in the comment sections of whatever platform you're watching this on, and let us know what you think. Any questions, feel free to ask them. We will be looking at the comment section here as well. So we'll go, with that being said, we'll go ahead and get started. And Dan, why don't you go ahead and introduce yourself?
Hello, I'm Daniel with Mason-McDuffie Mortgage. I've been a loan officer for over 40 years in Monterey County, and I've been through all kinds of changes. I'm the branch manager here as well. I can consider myself a concierge loan officer. So my preferred way of working is I meet with the client in person. We could do it over the phone or they can apply online as well, but I enjoy it a lot more meeting them in person, and I can show them numbers on paper in front of them and ask their questions as they come up right then. I have a fantastic processing team here, but for any contacts about the loan, you won't be talking to a team member. You'll be talking to me. So that's where the concierge part comes in. You don't talk to 3 or 4 other people. You just talk to me if you have any questions. Things always come up with loans. We got to explain things on credit or employment, and that's where I help you with those issues, if they are issues, or just help clarify things.
I think that's great. That one-on-one is important.
And I've, like I said, people can apply online or we can do it over the phone. I just enjoy it, meeting people and working that way. So I want to preface this. I know we're going to talk about reverse mortgages because I'm really excited about them. I just got recently approved to do them with my company, but I'm not an expert on it. I did some quite a few years ago, but I've always thought I would get a reverse mortgage for myself when I want to have extra income and I'm a little bit older. I don't plan on ever retiring, so as long as I'm able to work, I will. But I always thought it would be a great thing not having a house payment. But I came across this scenario, which I referred to a buddy of mine in Roseville, who has been doing reverse mortgages for at least 10 years. And I've been working on it with him. And in this scenario, this lady is 78 years old, lives in Carmel Valley. Her house is worth about $1.3 million. She owes $70,000 on her home, and her payment's about $1,200 a month. So she has pretty high payments for how much she owes.
Yeah.
She has Social Security income of about $900 a month, and she's like a part-time music teacher, and maybe makes another $1,000 to $1,500 depending on the month. So she's, doesn't have a lot of money to live on. So with this scenario, she's getting a proprietary reverse mortgage. She will pay off her loans on the property now. She will get $76,000 at closing, and she will have a line of credit available to her of $498,000. So, and she can take that. She can't take that the first year, but after the first year, she could take it as $3,000 a month, or $4,000 a month, or any amount she wants per month, or she could take it in a lump sum. She has all kinds of ways to help her make her payments and live comfortably for the rest of her life. And either way, she's got no house payment. In her case, she'll be paying her taxes and insurance on her own. But imagine, so with the money she's getting now, the $76,000 out plus the $498,000, she's going to have, $574,000 available to her. And if she takes it at $3,000 a month, she will have, that's probably like making $4,000 or $4,500 a month because it's a loan. There's no taxes or insurance taken out. So it's $3,000 net to her a month, which will really help supplement her income. Gotcha. And like I said, she could take it any way she wants. Anyway, so I'm kind of thinking that in 12 years, I'll be 78, and hopefully with appreciation like we have in Monterey County, my house will be worth similar to what hers is worth now. And
hmm
thinking, man, I would love that.
Yeah.
That'll really
Yeah.
supplement my retirement plans.
Gotcha.
But I like I said, I'll keep working, but
hmm
income plans.
Yeah. And you mentioned so that kind of leads into my first question is you mentioned she was taking a proprietary reverse mortgage.
Right.
So are there different types? So I get an
Yeah.
idea of what a
There's
reverse mortgage is, but
there's
yeah.
probably, well, I know of about 6 or 7 different types.
Oh wow. Okay. I didn't know
And
that.
you've got FHA HECM, you've got the fixed, you've got the adjustable. Um, you get with the adjustable, you get a lot more money on the table.
hmm
The unusual thing about reverse mortgages is that they, first of all, you have no payments.
hmm hmm
And, so that in itself could be a big benefit to somebody. And then you
hmm
can pull your money out. And, it's a negative amortization loan. And people hate that term, negative amortization, but
Right. Right.
that's what it is.
Okay. Okay. That's a good way
So
to describe it. Yeah.
so the payments they're not making adds to the loan, and loan balance increases.
hmm hmm Okay.
Um, and if they don't pull that money out of the equity line, that goes up as well, and they have more money available to them later.
Okay.
Um, so, but this program I mentioned to you just now is it's a jumbo conventional adjustable reverse mortgage, and it seems like the adjustable reverse mortgages give you the most cash out,
hmm
um,
hmm
which to me, I don't really care about if it's an adjustable or fixed rate. I just care about the cash flow I have to live on in
hmm
later years.
Okay.
Um,
So that means
and
like when you say adjustable is so let's say I had started when rates were 3% and now they're 7. So that means my balance, the total amount gets charged based on the new adjustable, or just what I've taken out as a balance, what I've
um,
used gets adjusted with
just what
interest
you've
rate.
taken out,
Just what I've taken out. Okay.
right?
So nothing changes on the overall approved amount or what I
No,
can draw from
no,
my
no.
original number.
Once it's set, what you can get.
Okay. Gotcha. Gotcha.
So
With the okay.
and these loans are also kind of weird. They're how much money you can get out of it is based on your age. It's almost like insurance actuarials in a way,
hmm
or
hmm
partially your age, the interest rate. The lower the rate, the more cash you can get out,
I see.
and the equity, and of course the type of program that you go with on the reverse
Gotcha.
mortgage.
hmm hmm
Um,
Yeah, so 7 different types of programs. I didn't realize that. That's an interesting point. And then you kind of touched on some of it, like so like the Carmel Valley client. That's a good example of someone that benefited from one.
mhm.
And so in her case, though, one of the other questions that I think a lot of people have is, well, why didn't she sell the house and just cash it all out? And
Okay.
just downsize into something a little smaller in Carmel Valley, one of the retirement communities there or something,
Yeah,
or a house.
that's always a possibility, if
hmm
especially in her case, because she has that much equity.
hmm
But, you know, depends what's available. You
hmm
know, in a lot of cases, in her case, because of her equity, she might be able to buy something else there. But,
Might.
I know some of the places have really high HOA dues, like $1,500 a month.
That's a good
Uh,
point. Yeah,
and
there's
the
several
ones
in.
in Carmel Valley. So I don't
Yes,
think
they
that
are.
you go from 0 to 1,500 and her income is pretty limited already.
Gotcha. Yeah, that's a
So
very
that
good point.
would be kind of hard for her to do. And,
Yeah.
it seems like most of the time when people sell in Monterey County to move to Idaho or Texas or somewhere else, they
hmm
probably can't move back because
Yeah,
they're buying something a whole lot cheaper, and it's going to be hard to come back and buy something more
more
expensive than their
expensive.
house is right now, a couple of
Right.
years down the road.
Yeah.
In a lot of cases.
Yeah. Yeah. That's true. Yeah. So it's kind of a similar situation in that sense. So, I mean, and it wouldn't make sense for her to get a home equity line of credit, right? Because that's a whole different.
Then she already has one right now, and that's part of her
Oh,
payment of
that's the
1,200 bucks
payment
a
she
month.
was doing.
She has her
Okay.
first and a second of 70. So,
Gotcha.
and she probably wouldn't qualify for home equity line of credit either.
Okay. So that makes sense. So, yeah, because I mean, and I'm just asking questions that, you think
Sure.
of as you're kind of mulling this out. That's why I really appreciate you doing this with us today. So most of the time it's a couple that's deciding this, but
Mhm.
what happens if we're husband and wife, and let's say I pass away, then what happens to my wife if
She can live there as long as she lives.
even if she's not on the loan? Like, let's say she's not on the original
Exactly.
loan.
Right.
Okay, so the scenario of
Well, if you're married, they would go by the youngest person in the household. That's how they base the loan on.
okay,
So if your
gotcha.
wife is 20, you wouldn't be eligible for it.
Gotcha. Okay, right. Good point. That's
How
a
old
good
is your
point.
wife?
Oh,
No.
she's about, yeah, she's gonna be my age. So yeah, in the
Okay.
50,
I just
we're
asking.
yeah. She'll kill me if I say it online, but but we're in our 50s, I gotta admit.
Okay.
So yeah, so it's just one of those things you think about, because um, you know, the worst thing a spouse would want is like, I'm trying to set this up for my family, but what if I pass away? I don't want my wife losing the house or getting
Yeah.
kicked
In
out or
my
anything
case,
like
my
that.
wife would get the house and would have the equity line and party time. No.
Okay, so everything continues, right? She can
Right.
now do what she needs to do. Okay, perfect. And now, what about if it's like if the home is in a trust, or um, or there's children involved? Like if there's kids, what about the heirs? What's something they should consider, or as a husband and wife, what should we consider about our heirs, or the people that will take possession after we move on?
Well, it's there's going to be less income or less cash for them,
Hmm.
for sure.
Yeah.
If the folks do this and pull the money out, and it depends how long they live. And um, like in this example of the equity line, if the um, if the client passes and she never uses any of the equity line, just except for the initial draw of the
Hmm.
76,000 and
Hmm.
the payment she hasn't made, then there'd be a lot of equity, because there'd be the 70 plus the 76 plus the closing plus payments not made for a year or so until she passes. So,
Hmm.
maybe it's just guessing 200,000 and the place is still worth $1,300,000 or $1,400,000 at that time.
Gotcha.
So there would be a ton of equity.
Hmm.
If they used up the, 574,000, then there would be a lot less equity, but still a pretty substantial amount. Um, I have a little graph in front of me
Hmm.
that I just did an amortization with, and I used a 5% appreciation year and a 5% appreciation per year. And what it shows is that on year 24, the heirs would have about 839,000 equity. So if you're, what's 78 and 24?
Hmm.
It's 102 or 3
Yeah.
or something,
Yeah.
102, I think. So, but on year 28, there's only 46,000 equity. On year 29, there's 0, and thereafter. So if if you live forever, you're to have no payments and you've got no equity. uh,
Gotcha.
but you know, it's hard to be. It's hard to know how long you're going to live, and
Yeah.
how things are. Both my dad and my grandpa died at 81. I plan on living to be 100 something,
Sure.
uh, but that 81 number is my plan is to beat them.
Hmm. Hmm.
I've always been
So
competitive with my dad, so my plan is to outlive him.
there you go. Right. I mean, we all hope that, right? You always got to shoot high.
Yeah, but who knows?
So
Yeah.
yeah. So of course, time and unforeseen occurrence that falls upon all of us. So what about if we tap it all out? What if I run out of equity?
Okay,
Then what?
then you run
Then
out
what
of equity.
happens?
It's in this scenario it was like 28 years, but in some scenarios, if they owed a lot more, it could be
Hmm.
15 or 16 years or
Hmm.
17 years.
Yeah.
Then you just keep not having to make any payments, and the bank um, eats the loss. It's a non-recourse loan, so they can't go beyond the property. So let's say the the parents pass in 20 years and there's no equity.
Hmm.
The the heirs can just turn it into the bank.
Okay.
When when the borrower passes, the last borrower passes, um, the heirs have 12 months to either sell it or refinance the property.
Mm-hmm.
A friend of mine, his mom passed a year ago, February, I think, and he refinanced the property and moved into it, and he lived like just down the street from her anyway.
Okay.
And so he just got a conventional loan and paid it off.
Paid it off, took it over. Okay, gotcha. So that answers a common question that I had about them is like, okay, what if I use it up, right? So, but that also means that if, like in that son's case, he purchased the home or took over the home and paid everything off. Now, one thing I have heard about reverse mortgages is that the heirs are a lot of times surprised by all the fees and how expensive it is. So what are some things they should ask about? Now, nothing changes. Everything that's disclosed up front is what happens at the back end, correct? Are there any surprises heirs should look for or questions they should
The
ask?
tricky part about it for the heirs is, you get a prelim and it says there's, in this case, maybe like 700,000 lien on the property, but the payoff of the loan is actually going to be, 200,000. So the lien is what shows is not really the balance. So the monthly statement will show the actual balance.
Gotcha.
So there's not excessive fees for the heirs. It's excessive fees for the original borrower. The fees are pretty high, especially on the FHAs. This particular one, I think the total fees are like 22,000 for in this particular case, but that's taken out of the loan. But the way I look at it also is, if you have a ton of equity, you're never going to use it. If you're going to stay in the property, the equity is just sitting there, never going to be used. You may as well use it to make your life a little more comfortable.
Right. So it really becomes the balance of, am I going to pay these fees, or do I want to downsize to a much smaller home at a lower cost that maybe doesn't have an HOA cost, or just a little tiny house, or maybe a condo with a lower HOA, something more affordable, let's say, or cheaper. I don't know, however you want to word that.
Right.
But then I also have to factor in, I'm going to have taxes on the home, even if I can transfer my taxes, like older ones can in California.
Right.
I think we get that one-time exclusion. But then you got to look at repairs and maintenance, ongoing maintenance, correct? Because I might need gardeners or people to come paint and keep the house up, right? Or does the bank factor that in?
They factor that in.
Okay.
And so my dad was one of the pioneers of doing reverse mortgages. And for while he was the number 2 person in California doing reverse mortgage, he did like 40 loans a year.
Wow.
Or 40 loans a month for a year.
Wow.
So he was like, he would go everywhere to do them. He would love taking trains. He would, hop on a train and go anywhere or drive or fly. I mean, he was all over the place doing these loans.
That's awesome.
All over California.
Yeah. And
he did primarily FHA HECMs, the fixed and the adjustable. That's mostly what they had when he was doing them. So I forgot my point.
Yeah. So just in terms of the bank taking into consideration the repairs and maintenance and the ongoing cost to it.
How it works in is you could have horrible credit and it didn't matter. You didn't have to have any kind of income. But now they look at your income and your credit as far as being able to pay your taxes and insurance. And they'll still give you a loan maybe if you've been delinquent on your taxes and insurance, but they'll do what's called a set aside, which means they'll put so much money aside to pay your taxes and insurance for you. So in this particular case with the Carmel Valley lady, she does not require a set aside because she's been current on her taxes and insurance. But that's one of the things they look at. So they would have more money set aside for somebody that didn't pay their stuff on time. So that would be less liquidity for them.
Gotcha. So they still give them the loan balance for it, but they assume that they're going to use a certain amount of it for taxes and whatnot. They don't have like an impound or escrow account for it or anything like that, right? They just kind of factor, this individual will need this much for the next 20 years.
I'm not really sure on that part.
Okay.
I know they have they know they do a set aside for
They
it. I don't know
factor
if
it
it's
in.
funded or not.
Okay, gotcha. Okay, well, good. Well, I mean, I think that answers all my questions. I know we're live, but I didn't really, I should have posted this maybe earlier, but if there are any questions, I would have seen them in the comments here. I believe they feed back, but if anyone does have any questions, we're going to put Dan's information in the comments section below. You'll have that below as well. And then, you can also reach out to him at Mason-McDuffie. If you have your number, Dan, I can even pop it on the screen here real quick. What's your cell phone number?
831-261-7180. That's my cell number.
180. Okay, so there you go. So if you need to get a hold of Dan, let me just get that up on screen here.
One thing I wanted to mention, it's the big thing is, it's there's counseling involved with this program before you can even start it.
Good.
And it's good to have your, heirs involved with it as well, so they can see it. When my dad was doing these loans, he would tell me stories. He'd love to go and talk to people and, find out their story when he's doing the loan. And he had all kinds of stories that he would tell me about his clients. But one of the things it'd be, grandma couldn't afford to buy birthday and Christmas presents for her grandkids, and they're eating top ramen and peanut butter all the time and just really struggling to get by. Where this program, really helped alleviate that. And that's how it was kind of initially when he was doing those loans. But some of them now, I talked to a friend of mine that retired earlier this year, and he lives up in the Bay Area, and his house is worth about $3.5 million. And he pulled $1 million, put $1 million on his house on a reverse mortgage. So, he's using that. He can use it anytime he wants if he sees some great investment, which is kind of frowned upon, really. But when you're talking to a counselor, they don't want you to just buy annuities or gamble with your money.
Right.
But my particular friend's always been a finance guy his whole career. So, but he sees some long-term investments that he's thinking he might use it for or not, but at least he has it available if he wants it.
Yeah.
So, and before it was, like I said, but he's well off and he's able to buy, lavish presents for his grandkids when he has them. He doesn't have any yet, but so that's kind of a different profile of a borrower than what it used to be for a reverse mortgage.
Good point.
And another thing is, the heirs are going to lose some equity. But if, like in my friend's case up in the Bay Area, if he wanted to help his kids out now with, gifting him so much money per year that's non-taxable, and they could do that, or even taxable, they could gift it to him and give them some of their inheritance ahead of time. So there's all kinds of, it's kind of changed a little bit from how it initially started.
Yeah. And that's a good point. It's like, this is just one avenue for people. So for individuals. And so, like you said, the heirs should consult with you or with the counselor on the loan. And then also, I mean, if there's a trust, they should obviously bring the trust attorney into the picture, and their CPA or their family attorney, however they need to address it. You want to, the more information they can get from all these sources, the better. That I think that's what I'm taking away from this, is like, there's so many different options for them. You want to explore them all, check them all, and then sit back and not make a rush decision, because obviously we're talking about homes that have a lot of equity in them. My biggest fear is, and I'm sure your dad ran into these stories of someone being taken advantage of with something like
when they first came out, there was some kind of B lender companies like Household Finance and Avco and some of those places that were would be taken advantage of it. And as my dad just did the FHA programs, which are administered by Housing and Urban Development, so they were buyer protective.
I see. A little more buyer eccentric, if you will. Yeah.
Right. So, those days are gone and those companies are gone.
There you go. Yeah. Okay. Well, that's good. Well, I got to thank you very much for taking this time this morning.
All right, well, thanks. My pleasure.
No, it took a lot of your time. This takes a lot of time to just do a few minutes even, but I really appreciate it. I think this is great information. And again, if anybody has any questions, be sure to reach out to Dan and his team. They'll be happy to meet with you and go over this process with you and answer any more questions you have. Again, this wasn't a sales pitch for anybody. This is, again, just to try to inform everybody, all our clients, friends, and relatives about what a reverse mortgage is and what the benefits are. And again, so we want to thank you again, Dan. Really appreciate it.
I also want to mention I primarily do, VA, FHA, conventional loans,
course.
jumbo, all that stuff. That's what I've been doing historically.
Yeah, that's true.
This is something that's got me kind of excited recently.
Well, before we go then, the $1 million question you get every day, probably 100 times a day,
not this
is how's the market? What are rates?
They're like in the low to mid sevens.
Low to mid sevens right now. And today is October 27th, 2022. So low to mid sevens today. So so that's even gone up 0.5% in the last month then. Yeah. Right. Because I think we had
it bounces around throughout the day. And we do offer, or we do have availability of people using a 2-1 buy down or a 1-1 buy down.
Right.
For FHA and conforming conventional loans.
Right.
But the buyer's not allowed to pay for it, and that means the seller or the realtor has to pay for it. The cost of a 2-1 buy down is approximately 2.25% of the sales price.
Oh wow!
Or the loan amount, I should say.
That's the maximum they can ask, or
no? That's just what the cost of a 2-1 buy down would be.
Is that right? The 2.5% of the buy down amount, or the entire sales price?
Let me give you an example. Let's say you had a sales price of 125 and 100,000 loan, and the rate was 7.5. To buy the rate down to 5.5 for year one would cost so much per month. Maybe it's $200 a month times 12. To buy it down to 6.5 in year two is maybe $100 a month times 12. They're a lot lower numbers than that for that loan amount.
Gotcha.
And so it would cost about $2,200 or so, roughly, to buy it down to 5.5 for the first year and 6.5 for the second year.
Gotcha.
So instead of a seller lowering the sales price automatically as an incentive for the borrower to be interested in the property, they could offer a 2-1 buy down or a 1-year 1% buy down, which of course is quite a bit cheaper. It's about a third of the cost of the 2-1 buy down.
Yeah, that's
and that gives the buyer a lower payments for the first year or two, and hopefully, I don't believe anybody that predicts rates, but there's all kinds of predictions that lenders feel rates are going to drop in the mid 4s sometime next year.
Yeah.
But who knows when or if that's going to happen.
Gotcha. So, if I'm a buyer today, would you recommend I lock my rate today if I'm just getting into contract right now, or wait a little bit since the rates are fluctuating? Lock it even today.
Don't play in the market. It's only been getting worse.
Okay.
And how we do it is, as Gertrude Stein said, a rose is a rose is a rose. With us, a lock is a lock is a lock.
I like that.
But if we locked you in at 7.5 and the rate dropped to 7, we would probably give you, we could float you down to like 7.25, somewhere in between, not all the way to the market.
Gotcha.
But if the market worsens, you're protected by that initial lock.
Gotcha.
Now, granted, we lock you in at 7.5 and it goes to 7.375, we're not going to do anything. But if it drops, 0.5% or more, we would give you some kind of break. Something that would be
that would make an impact, right? Okay, good. Well, thanks. That wasn't part of what we talked about earlier, but it's I know a common question, and of course, once we record this and it posts, it's going to be kind of irrelevant too, because the number would have shifted anyway. So, but it's always good to know. So we appreciate it again, Dan. Thanks again for this.
Okay, great. Thank you, Israel.
Yeah, we'll talk to everybody soon. Thanks again, everybody. Appreciate you being here for us.